If you go back 2 years to the end of 2021 and the end of the pandemic, inflation rose pretty sharply everywhere and interest rates had to come up from zero. The rise in interest rates from zero was quite bad for investors, but it was good for savers. It was also tough for borrowers. For people with mortgages, it was very difficult because it meant their budgetary pressures escalated, and that added to what they were already suffering from with the higher cost of living from inflation. So yeah, they had pretty difficult times. But broadly speaking, in terms of the government's objectives, it's turned out pretty well. The inflation rate's come down. It's now down to around 4%, and yet the economy still kept growing. Typically, historically, getting inflation down has been difficult, and it's generally been associated with recessions, which drive markets lower and give poorer investment returns, and none of that's happened. It's allowed for central banks to start to talk about lowering interest rates, particularly overseas. The US central bank's talking about lowering interest rates quite explicitly, whereas our Reserve Bank is still keeping an open mind about the next moves. The situation in the US is very good, and it's driven the stock market strongly in the last few months. The main thing we want to be telling people at the moment is that the risks that were around over the last 2 years look like they're less now because inflation has been lowered. And so we want to make sure investors are now a bit more fully positioned in investments, shares, property, interest-bearing investments that are now paying good interest, rather than be sitting on the sidelines. There's as much risk now of missing out on a very good period as not.